Okay, so it's Wednesday, January 21st, 2026. And if you were, glued to the market tickers this afternoon, you probably did a bit of a double take when you scrolled past the regional
Oh,
banks.
yeah, because something pretty spectacular happened with Citizens Financial Group.
I mean, it's not every day you see what they call a super regional bank stock jump over 7%, not in one session,
Exactly. The stock closed at $64.01.
which is up $4.20 on the day. And look, in the world of crypto, or some tech startup, a 7% move is just a Tuesday morning.
It's nothing, yeah.
But for a bank, a whole sector that, let's be honest, prides itself on being boring and steady.
This was a fireworks show. It really was.
And usually you see a legacy bank move like that, and your first thought is a merger.
Right, you immediately start checking the news wires to see who's buying them out.
But that is not what happened here.
Not at all. No rumors, no hostile takeovers.
No. What we have is a stack of paper. We've got the Q4 2025 earnings release, the investor slide deck, and the full transcript of the earnings call. The one with CEO Bruce Van Saun and the new CFO Anui Banerjee.
Right. And our mission today is really to figure out why this specific stack of papers got Wall Street so incredibly excited.
It's such a fascinating story because on the surface, if you just glance at the headlines, it looks like a standard good quarter.
Yeah, solid quarter. But when you peel back the layers, which is exactly what we're going to do, this report is actually a validation.
A validation of
It's the market finally turning around and saying, okay, we see this really risky strategic pivot you made a few years ago, and we have to admit, it's actually working.
And we're talking about their private bank strategy, right? This aggressive hiring spree they went on and a huge tech overhaul.
Exactly.
Yeah.
This is basically a case study on how a traditional bank tries to morph into a modern wealth machine without actually buying another company.
Okay, so let's get into it. Let's start at the top with the headline numbers that triggered this whole rally. What did Citizens actually report that had traders smashing the buy button?
So looking at the bottom line, the beat is pretty clear. They reported earnings per share EPS of $1.13.
113. And the analyst consensus was sitting at 111.
Right.
Okay, so they beat by 2 cents. 2 pennies. I mean, don't get me wrong, a beat is a beat. But is 2 cents really enough to send a $40 billion company up 7%?
On its own. Probably not. No, if that were the whole story, you'd get, some polite applause and maybe a 1% bump.
Right.
But the excitement comes from the quality of that number, and especially the year-over-year trend. Look at the net income, $528 million.
And that's up.
That's up 32% compared to this time last year. That is a massive, massive jump in profitability.
32% is huge. But this is where I got a little confused looking at the spreadsheets. I'm looking at the top line, the revenue. Revenue was $2.16 billion.
Which was, technically, a tiny miss against expectations.
Right. They missed revenue by what, $21,000? Which, for a bank this size, is basically the cost of a used Honda Civic.
It's a rounding error.
Yeah, so revenue was basically flat. So, help me out here. How do you have revenue that is just standing still, but profits are skyrocketing by over 30%?
That, my friend, is the magic of operating leverage.
Okay, operating leverage. We hear this term thrown around constantly during earnings season. It sounds great, very technical. But let's strip away the jargon. What does that actually mean for the bank?
Think of it like a pair of jaws. The top jaw is your revenue, all the money coming in.
Okay.
The bottom jaw is your expenses, all the money going out. You want those jaws to widen.
You want to widen the gap.
Exactly.
Mm-hmm.
Operating leverage is what happens when your revenue is going up, or, in this case, even just staying steady while your expense side is getting lighter or just growing much, much slower.
So they're squeezing more profit out of every single dollar that walks through the door.
Precisely. Citizens delivered a positive operating leverage of 5.2% year over year. That means the gap between what they make and what they spend got significantly wider.
And there's a metric for that, right? The efficiency ratio.
The one bankers love.
Yeah.
It measures how many cents it costs you to make $1 of revenue. You want that number to be as low as you can get it.
And theirs got better.
It improved by 79 basis points, bringing it down to 62.2%.
So for every dollar of revenue, they're spending roughly 62 cents to get it.
Right. And in a low-growth environment, which 2025 largely was showing, you can manufacture profit growth just by being better at the mechanics of banking is something investors absolutely love to see.
It proves management has their hands firmly on the controls.
Exactly.
Okay, so the engine room is running efficiently. They've tightened all the bolts. That explains the profitability jump. But, you can't cost cut your way to greatness forever.
No, eventually you need growth.
And that brings us to the most interesting part of this whole report and really the heart of this validation story we talked about. The private bank.
This is the pivot. This is the big gamble.
So take us back a couple of years just to set the scene. We saw the collapse of First Republic, Silicon Valley Bank. I mean, absolute chaos in the regional banking sector.
That's totally okay.
Most banks were just hunkering down, hoarding cash, trying not to be the next headline. What did citizens do?
They went on the offensive. They looked at the wreckage of those collapsed banks, and they saw something valuable. The people.
The talent.
The talent. All these top-tier wealth managers, private bankers, suddenly available or, unsettled because their institutions were just falling apart. And citizens decided to execute a lift-out.
A lift-out. It sounds like a rescue mission.
In a way, it is.
Yeah.
But instead of buying a bank, which is the traditional route, where you acquire their ledger, their old computer systems, their bad loans, all the baggage,
Right.
you just hire the teams. You lift the team out of the old bank and just drop them into yours.
But that has to be expensive, right? These are not entry-level people. These are rainmakers. You're paying them signing bonuses, huge salaries, setting up new offices.
Oh, it's incredibly expensive and, more importantly, incredibly risky. You are front-loading a ton of cost. You're spending millions on compensation and real estate with zero guarantee that the revenue will actually show up.
Because the clients don't have to follow the banker.
Not at all.
Yeah.
The clients could just stay where they are, or they could go to JP Morgan or Bank of America.
So for a while, Wall Street was looking at this strategy and asking, is this going to work? Or are you guys just burning cash on expensive hires?
And this Q4 2025 report is basically the answer to that question.
And the answer is?
A resounding yes.
Yeah.
The numbers coming out of this private bank are staggering for a division that's this young. Deposits in the private bank reached $14.5 billion.
$14.5 billion.
Which exceeded their own internal targets. They have client assets hitting $10 billion and about $7.2 billion in loans out to these clients.
Wow.
But the number that I had to double check, I actually went back to the transcript to make sure I read it right, was the return on equity, the ROE.
The ROE is the gold standard for profitability.
The private bank generated a 25% return on equity in 2025.
25%. Whoa. Okay, put that in context for me. What would a normal, well-run regional bank hope for?
A normal, well-run bank might hope for an ROE in the low teens, maybe 12, 13% on a really good day.
Okay.
Hitting 25%, that is exceptional. That's like investment banking levels of return.
And management also said this division was accretive to income.
Right. Accretive just means it added to the profit instead of being a drag. Usually when you launch something new, it loses money for a few years while you scale up.
Sure.
They originally projected it would boost pre-tax income by 5% in 2025. It actually boosted it by 7%.
So they're ahead of schedule and more profitable than they even hoped.
Way ahead. And they've added 10 wealth teams since the launch in late 2023, expanding heavily into the New York City metro area.
But I need you to sanity check something for me. I was reading the call transcript, and there was a note about credit losses in this private bank portfolio.
I know exactly what you're looking at.
It said zero.
Zero.
Zero credit losses. How? They have over $7 billion in loans out there. Mortgages, lines of credit. How is it statistically possible to not lose a single dollar?
It sounds too good to be true, doesn't it? But it really speaks to the specific nature of this lift-out strategy.
How so?
When these bankers came over, they brought their book. These are clients they've often served for 10, 20 years.
So these are high net worth individuals, stable finances, people the bankers know inside and out.
Exactly. The CEO, Bruce Van Saun, made a point of this on the call. He said, and I'm paraphrasing, we're lending to people we know well.
Relationship banking.
In its purest form. When you lend to ultra-wealthy clients that you have a deep history with, the default rates are historically microscopic. They have the liquidity to pay you back, even if the economy gets rough.
So the real gamble wasn't on the credit quality. It was a gamble on whether the clients would actually pick up the phone and move their accounts.
And clearly they did, in droves.
And they're not stopping. I saw they're targeting 18 to 20 billion in deposits and up to 13 billion in loans for the private bank in the medium term.
This isn't a side hustle anymore.
Yeah.
This is quickly becoming the core growth engine of the entire bank.
It is. But here's the catch, right? You can have the best relationship bankers in the world sipping coffee with billionaires, but if your back office tech is stuck in 2015, you're going to bleed margin.
You're absolutely right. You cannot support a modern private bank with clunky legacy technology.
Which segues perfectly to the other big pillar of this report, the technology program. They've given it a very, let's say, aspirational name.
Reimagine the bank.
Reimagine the bank. That sounds like a marketing slogan you'd see on a billboard at an airport.
It does. But when you look at the CFO's comments, and remember, this was Inouye Banerjee's debut earnings call as CFO. He wasn't talking about billboards. He was talking about some serious re-engineering.
He's talking about hard dollars. They're targeting $450 million in pre-tax run rate benefits by the end of 2028.
$450 million. That is a massive number. Is this just, standard cost cutting, firing people, closing branches?
That's what I assumed at first.
There's always a little bit of that in banking, but this is different. This is heavily, heavily driven by artificial intelligence. They listed about 50 specific initiatives, and unlike a lot of companies that just wave their hands and say, we're doing AI to pump the stock.
Right, the buzzword.
Citizens gave very concrete examples.
Really? Give me the highlights. What does an AI-driven bank actually look like in practice?
Well, the biggest one, and the one that might be the most controversial, is the call centers. They're aiming to have 50% of customer calls handled without a human, using voice AI.
50%, half of all calls. That feels
Right.
risky. I mean, we've all been there, shouting representative at a robot. If they get this wrong, people are going to leave.
That's the danger, for sure. But the technology in 2026 is vastly different than it was even 2 years ago. The goal is that for simple things, balance checks, transfers, basic questions, the AI is actually faster and more accurate than a human. If you can automate half of that volume with AI that is actually competent, that completely changes your cost structure, you're saving millions in labor.
And it probably changes the customer experience, too, hopefully for the better. What else?
Coding. This one is huge for their speed to market. They're using GenAI to increase engineer productivity by 5 to 10 times.
Wait, 5 to 10 times, not 10%.
No, 500 to 1,000%. The way they describe it is the AI writes the first draft of the code. The human engineers stop being typists and start being editors, quality assurance officers.
That sounds incredible, but does it really work? I mean, we've heard these promises about coding productivity before.
It's tricky in a regulated environment like a bank. You can't have the AI hallucinating and breaking the banking app. But if they can achieve even half of that gain, it means they can roll out new features, fix bugs, and update security protocols so much faster than their competitors.
It's an agility play as much as a cost play.
Exactly. And the third big area was fraud and risk, using AI to analyze credit profiles and catch fraud faster. This all loops back to that efficiency ratio.
Fewer losses, less manual review time, higher margins.
Right.
But let's be realistic. Building this stuff isn't free. You don't just, download Bank AI from the App Store.
No, and to their credit, they were very transparent about the price tag. They expect about $50 million in one-time costs in 2026 just to get this stuff running.
So that's a drag on earnings for this year?
It is.
Yeah.
But they also expect to see about $45 million in benefits in the same year. So for 2026, it's basically a wash.
It pays for itself almost immediately.
Correct. And then in 2027 and 2028, once the systems are built, the costs drop off and the savings just stack up. That's when you get to that $450 million number. It's a classic spend money to save money strategy.
Okay, so we have the private bank bringing in the revenue and Reimagine the Bank cutting the costs. But there's a third piece to this puzzle. Every bank has that, closet full of stuff they wish they didn't own, the non-core assets.
The bad bank inside the good bank.
Exactly. So how did Citizens do on cleaning out that closet?
They took a flamethrower to it. At the start of the year, they had $6.9 billion in assets they categorized as non-core.
Legacy loans, old portfolios.
Stuff that just doesn't fit the new strategy. By the end of Q4, that number was down to $2.5 billion.
They cut it by more than half in 1 year.
Way more than half. They sold off a big student loan portfolio, which helped. But the significance here isn't just about tidiness, it's about capital freedom. Every dollar of capital that's tied up in a non-core asset is a dollar that isn't earning that 25% return in the private bank. It's just dead weight.
So by dumping the dead weight, they free up the capital to go feed the winners.
Exactly. It improves the entire return profile of the whole institution.
Now, I have to ask about the elephant in the room. Or maybe the empty office tower in the room. Commercial real estate. Specifically, general office space.
Ah, yes. CRE.
Every time I open a financial paper, there's another story about an office building selling for pennies on the dollar. Banks are terrified of this. What's Citizens seeing?
This was actually a major relief point in the report. They noted that the portfolio was working out as expected.
Working out as expected, that sounds like very careful, deliberate banker speak.
It is, but in this climate, expected is a massive victory. It means no sudden explosions, no surprise defaults.
And the numbers back that up.
They do. Their provision for credit losses, that's the money they have to set aside for bad loans, actually dropped by $25 million year over year,
So they're setting aside less money for doomsday scenarios, not more.
which implies confidence. But here's the key. They aren't being reckless. They have a coverage ratio, their rainy day fund, of 10.8%, specifically for that general office portfolio.
So they have a cash cushion of nearly 11% of the value of those loans just sitting there in case things go sideways.
Right. So even if defaults tick up, even if a few buildings go under, they've already accounted for a huge chunk of the pain. It stops being an existential risk and starts being just a managed cost of doing business.
Okay, so they've cleaned the house, they've built the tech, they've launched the private bank. Let's look forward. It's January 2026. What are they telling us to expect for the rest of this year?
The outlook is surprisingly sunny. Management is very, very optimistic.
Give me the forecast.
For net interest income, that's NII, they're projecting growth of 10 to 12%.
Double-digit growth in interest income in this environment. That feels aggressive.
It is aggressive. And they see fees up 6 to 8%, driven by that wealth and capital markets engine.
But here's the thing about forecasts, right? Every forecast is based on an assumption about the world. What kind of economy does Citizens think we're going to have in 2026?
That's the critical context. Their whole model assumes a soft landing.
Okay.
They're betting on solid GDP growth, stable unemployment. But here's the part that anyone with a mortgage or a savings account should listen to. They are assuming 2 Fed rate cuts this year.
2 cuts. When are they penciling those in?
June and September.
Okay, so they aren't expecting rates to just plummet tomorrow. It's a gradual easing.
Exactly. They see the 10-year Treasury anchoring around 4.25%. If that scenario plays out, their guidance looks solid. If inflation spikes or the economy crashes, then, all bets are off.
Of course. And for the shareholders, the people who actually own the stock, what do they get out of this besides the stock price jump?
Cash. They're planning $700 to $850 million in share repurchases in 2026.
Buying back their own stock. That's usually a sign management thinks the stock is still undervalued even after this big jump.
It is. Plus, they're targeting a Common Equity Tier 1 or CET1 ratio of 10.5 to 10.6%.
And just briefly, for the non-bankers, why does that CET1 number matter?
It's the ultimate measure of a bank's financial strength. It's the buffer against bankruptcy. The regulators watch this number like a hawk.
And 10.5 is good.
10.5 is a very healthy, very robust number. It basically says we can give all this cash back to shareholders and still be one of the safest banks on the street.
Usually when a bank has this much capital, a strong stock price, and this growth mindset, the conversation turns to M&A.
Mergers and acquisitions, yeah.
The regional banking sector loves a good merger. Who are they going to buy? Did Van Saun say anything about going shopping?
He was actually quite explicit about not doing that.
Really? Usually CEOs kind of leave the door open, we're always looking for opportunities, that kind of thing.
Not this time. He said, and this is a quote, "Notwithstanding several of our peers gauging on acquisitions, our focus for the foreseeable future remains on our attractive organic growth agenda."
Translation: we aren't buying anyone, we're building it ourselves.
And why would they buy? Think about it. We just spent this whole time discussing how they built a top-tier private bank from scratch just by hiring people.
Right.
Why would you pay a 30% premium to buy a competitor's balance sheet when you can just hire their best staff and pay 0 premium for the company itself?
It's the classic build versus buy debate, and Citizens has clearly picked a side.
And looking at this quarter, with the 7% stock jump and the 25% ROE, it looks like they picked the winning side.
So let's zoom out. If you're listening to this and trying to synthesize all these different numbers, what's the one main takeaway? Why does this particular report matter?
The takeaway is that Citizens Financial Group has successfully executed a major pivot. They've moved from playing defense, just worrying about regulations and bad loans, to playing offense. They proved that the private bank is a real, profitable, high-growth engine. And they have a clear roadmap to modernize the rest of the bank with AI that is actually funded and already delivering results.
It feels like they've really shed that old traditional regional bank skin. They aren't just a place to park your checking account anymore. They're morphing into a wealth management firm that just happens to have a banking license.
That is a great way to put it. They're chasing the high-value dollars, and they're using technology to manage the low-value transactions.
Hmm.
It's a very clear bifurcation of the business model.
So here's a provocative thought to leave you with. We've been talking about this lift-out strategy hiring teams instead of buying entire banks.
Right.
Citizens achieved massive growth, zero credit losses so far, and a 25% return by doing this.
Yeah.
Does this signal the end of traditional bank M&A? I mean, think about it. If you can get these kinds of returns by just hiring the best bankers and ignoring all the legacy systems and the bad loans of their employers, why would anyone ever buy a whole bank again?
That's a fascinating question.
Yeah.
It suggests the future of banking growth might not be about acquiring ledgers or physical branches,
Yeah.
but about acquiring Rolodexes.
The people, not the paper.
Exactly. The value is in the relationship, not in the vault.
Something to chew on as we watch the tickers this week. That's it for this deep dive into Citizens Financial Group. Thanks for listening, and we'll catch you on the next one.